That was so yesterday. And what we mean by that is the market has a very short-term memory. The focus of the market changes. Okay, when something more important comes into the market, or at least traders feel is more important, they will change the focus of what affects the market. Okay, so it's important to learn to watch for what the current market focus is to understand what is relevant to your current trading. You can listen to the talking heads or other traders, news articles, price reaction to fundamental data, or other correlations such as equities and commodities. All can give you an idea of where the market focus is. And this is important because wherever the focus is, the market's going to be that much more sensitive to information or data coming out related to that subject of focus. For example, when the oil market was skyrocketing, everybody was talking about oil prices and gas prices. One of the data releases that had a large effect was the crude oil inventories. And normally that didn't have very much of an effect on the market at all, from the intraday perspective. But while the market was focused on that, it did. We saw some volatile price action when we had that data come out. In 2008, when we had the market crash, the market was focused on risk at that point. So we saw a switch between the market going risk averse and then increased risk appetite coming back into the market. And that was the focus, and that's how price reacted. More recently, again, the oil market has come into the picture. All right, we've seen the US dollar react to the oil market. We've had a sharp decline in oil. Also, at the same time, there's been a lot of fundamental talk about interest rates in the U.S., about the growth and potential rate hikes. Okay, so the market was pricing in potential rate hikes for June, maybe September. June obviously was the focus, the June meeting. And both of these factors and a continuing to rally stock market has all been positive for the U.S. dollar. Let's take a look at a chart here, and I just want to show how the market focus can change just looking at the correlations between, we'll use the US dollar and the S&P here. Now, this is a weekly chart of the S&P and the US dollar. The US dollar is the candles here, and the S&P is the blue line. And where I want you to focus is right in this area here. See how we basically had a correlation with the US dollar and the S&P right here until this point in 2000. This was in 2008. This was actually February of 2008. And if you remember the big stock market crash that happened through 2008 into 2009, this is where we saw the market go into what we call a risk on, risk off mode. Now, right in here, you can see the basic correlation where the S&P was coming down, the US dollar was coming down right until right about here. Okay, right about here, it was in, we'll call it March of 2008. Okay, then in March of 2008, the market started to get concerned. The market started to get concerned with this decline in the S&P. So what did we see happen? Okay, all of a sudden now we're not seeing this correlation anymore. We're seeing money flow into the US dollar as a safe haven currency. Okay, so as the S&P continued to fall here and fall very hard, the US dollar started to rally very hard. This is the market going risk averse. This is money flowing into the safe haven US dollar currency. Then what you see right here, as the stock market bottomed out, the US dollar here topped out. Now, as the rally in the stock market came, we started to see some money flowing back into some of the higher yielders, out of the US dollar, as risk appetite came back into the market. And it was during this time period right in here where intraday trading when we saw positive U.S. data come out that was good for, or traders or investors considered it good for the global economy, we were seeing equities rally and we were seeing the U.S. dollar decline. And you can see this relationship basically stayed in place. This risk on, risk off relationship stayed in place all the way until near the end of 2011. Okay, near the end of 2011 is when we started to see the market focus shift. And since then, we've seen more of a correlation here to a point. Obviously, we had a really large correction in the U.S. dollar here while the equities market continued to rally. Okay, but then you can see the focus shifted. Now we started to see the equities market rallying strong and the U.S. dollar rallying strong. So what was happening here? This is where we started to see the oil market really decline. Okay, so the focus was on the oil market, and here we also had the talks of the potential rate hikes coming from the Fed. So that's what we saw during this entire rally. That was the market focus. Now, what's happening in here? We're still seeing the equities market rally. Now we're seeing the U.S. dollar start to decline. Okay, and this is a corrective cycle that we're looking at. But what's happening? Okay, the Fed, the market's pretty much discounting the idea of the Fed increasing rates at the June meeting because of poor data. And we've also seen the oil market starting to rally a bit, correcting that decline. Okay, so my point is, it's very important to understand where the market focus is, because that focus is going to dictate how the market reacts on a day-to-day basis. Remember, we talked about some folks that are calling themselves fundamental traders. Well, they're really sentiment traders if they're trading short-term intraday. Because if you were back in this environment, if you were in this risk-on, risk-off environment, and you were buying the U.S. dollar when we had strong U.S. data coming out, you were going to get creamed. You were going to get creamed because the market was not reacting to that data by strengthening the dollar. The market was reacting to that data by a weaker U.S. dollar because money was flowing out of the dollar and into higher yielders. If you're trading in the current market, there's a heavy focus on oil right now in the commodities market, as well as the intraday macro data that's coming out because of the focus on the Fed and the potential for rate hikes coming at some point this year. At least that's what the market is expecting, either June or September. And I think now the market has started to discount the June rate hike, so they'll start to focus on September. So as traders, that tells us what to focus on. We want to keep a close eye on the commodities market, get a close eye on the oil market, as well as understand how the market is likely to react to positive U.S. economic data, which right now would be bullish for the U.S. dollar. Okay, folks, so we're always going to trade the market technically, but it's very, very important to understand what is happening, what the bigger picture is that is driving the current sentiment.